Welcome, guys, to another video in the Refine series. In this video, we'll be talking about PD arrays, and I'm very sure that if this is your first time hearing the term PD arrays, it's going to drive at a lot of confusion. It's going to drive a lot of confusion to your minds, but I want you to walk with me as I take you on this adventure. So, in the market, all you are seeing in the market every day is we have money going up and money going down. This money going up and down is called liquidity. Okay, money is going up, money is going down every day. Money goes up, money comes down, money goes up, money comes down, and we want to ride the wave up and we want to ride the wave down. But now the question is, at what point, or from what point do we join this ride? At what point do we join the move upward, and at what point do we join the move downward? And what makes it very easy for you to spot the points at which you could join, you could participate in the movement of price either upward or downward, is what we call PD arrays in the market. And these arrays are of different types. Okay, and so let us define the term PD first. PD simply means premium and discount, and this is a Fibonacci tool. So if you want to find this tool, you just want to go here for forecasting and measurement. Okay, for you see it here, the Fibonacci retracement tool, and you could edit this tool to give you all forms of different data that you'd want. Me, basically, I just like to turn on the 0, 1 and 0.5% data. So I turn off every other thing and just leave this three on. So you might want to do that in your own chart if you want to understand what I'm saying for now. Okay, so let's um yeah, turned on. So if I use this tool and drag it from, maybe let's say, from this low to this high, from this low to this high, everything above the 50%, which is 0.5, is a premium, and everything up below the 50% is discount. And I will be explaining this more in-depthly in the video I'll be releasing soon, called titled Order Flow and Liquidity. So for now, I want you to have this at the back of your mind, that everything above the 50% is premium and everything below the 50% is discount. Already you know that discount are for buys and premium are for sales. Everybody wants to buy at a cheap price, and every seller wants to sell at a higher price. Basic economics 101. Okay. Now the question is, at what point do I join this movement upward? And at what signals to me that this is a perfect time to join the market going down, when it is going down? So these are questions that the PDRA seeks to answer. Okay, it seeks to answer the question of, at what point do I join the market, when it is either moving upward or when it is moving downward? And I hope that makes sense to you. So we have different types of PD arrays. And what's an array? An array is simply a structure that stores data. If a fundamental data structure that is used for efficient storage and retrieval of data. Okay. And like I said, everything going on in this market is just money going up and down. And when we place our orders, in the market. Our orders are stored in these arrays. Our orders are stored in the arrays. And when I say order, I mean either buying order or a sell order. Whenever we place a buy or a sell order in this market, those orders are collected and stored in arrays. So the market usually target these arrays to retrieve our orders in the market, and then if we wanted to buy, that means we spotted a discount array where we placed our order, and the market stored our order in that discount array, and then the market retrieves that order, and if we are right, the market logs us into the market, and we are either making money or we are losing money from there. What I'm saying might sound so crazy, so let me depict it to this image. Let's say market is about to go up, and I've spot an opportunity to join the buy, and I place my order, and I placed my order here, a limit order. Let's just call it a limit order here. What I'm basically doing is that I'm saying I'm giving an instruction to the market that if the market drops below and taps into this PD array where my order is stored, the market should retrieve my order, lock me in, and if I'm right, that price would buy from this point of interest that I have marked, that I have placed my order in. The market will pick my order, fill me in, and I will be able to ride the wave as price keeps going upward, which means I'll be making money. But if I'm wrong, and market goes below this point of interest, the market locks me in, and maybe I placed my stop loss order limit here, which is basically telling the market that if price goes below this low, take me out of the market with a loss. I don't want to lose more than the value I would lose if price goes below this low. So if I'm going to lose $200 if price goes below this low, I'm accepting that risk, and I'm willing to lose that money as soon as price goes below this low. But if I don't set any stop loss limit order there, I don't know how much I'm going to lose if price keeps going lower than this low here. It could be 400, $500, and you don't want that. So basically, you want to lose less and make more in the market. And what that is what a stop loss limit order does for you. Okay. But if I'm right, market picks my order here, fills me in, and I'll participate as price keeps moving upward to my objective. Remember, price is always going up. Price will always move up until it meets an objective, then it reverses. Okay, so now we've gotten that definition out of the way, and I hope it made sense to you. Let's define the different types of PD arrays in the market. So we have the order blocks, we have the breaker blocks, we have the mitigation blocks, we have the fair value gaps, we have highs and lows, and we have other type of PD arrays. But basically, when I'm teaching people, I like to restrict their knowledge of this to the four basic PD arrays that I think they should learn, and forget about the rest of the noise. But there are so many resources online to study more about these PD arrays if you want to. But for the purpose of this series, I'm going to be teaching just four basic fundamental or four basic PD arrays. Sorry. So highs and lows. We'll be talking about order blocks in this series. We'll be talking about fair value gaps, In this series, we're talking about breaker blocks. In this series, I'll be talking about mitigation blocks. Okay, so there are five. So we're talking about highs and lows, order blocks, fair value gaps, breaker blocks, and mitigation blocks. All right, so let's begin with the highs and lows. There will be a part two of this lecture just because I'm my objective is to keep our videos at the minimal of 25 minutes so you don't get bored watching the videos and you get every information you need to thrive in this market. All right, so let's begin with highs and lows. Like the term already signify, a high is simply a high. This is a high. Why is this a high? This was the highest point price got to before it started reversing, so it's a high. And why is this a low? This was the lowest point price got to in this series of price action before price started reversing higher. So that's why it is called a low, why this is called a high. This is a high, all right? This was the highest point price got to before price started reversing. This is a low. This was the lowest point price got to in this series of price action before it started reversing upward. Okay, this is a low because this is the lowest point price got to before price started reversing upward. And this is a high. Why? This is the highest point price got to before it started reversing downward. This as well is a low. This is a low because this is the lowest point price got to before reversing upward. And this is a high because this is the highest point price got to before reversing lower. I suggest you watch the video on market structure so you understand. Basically, you would adding that video to what I'm talking about, what I'm saying now about highs and lows will make your understanding of this concept better. So this is a high. Why this a high? Exactly, you're getting it now. This is a high because this was the highest point price got to before price started reversing in this series of price action, right? This is a low, this is a high as well. So we have two highs here, relatively equal highs, and we have this low here as well. This is a low. Why is this a low? Because the lowest point price got to before started reversing. This as well is a low. Okay, so the lowest point price got to before it started reversing upward. Okay, and this is a high because this is the highest point price got to before it started reversing downward. This is also, these are all highs, right? And these are all lows. Okay, so I don't want to go over that many times. How many of you could remember this image? I left this image here intentionally because in that video of market structure I talked about how price takes out a high and trades lower to take out a low, because in a bearish market structure, price is rejecting highs and breaking lows. So if you understand, if you go back to that video and watch the commentary I did when I put up this image, these diagrams here, or whatever you want to call it, then you understand perfectly what I'm talking about when I talk about highs and lows. Okay, so and as well in a bullish market structure, price is rejecting lows and taking out highs, rejecting lows and taking out highs. Okay, so if you've not watched the video on market structure, I strongly recommend that you go back and watch that video. I think with this, you could basically understand what a high and a low is. Okay, so this is very basic. This is the basic of the basics, and I'm trying to make it as easy and as comprehensive as possible. This is a low. This was the lowest low price put in before price started reversing higher in this series, and this is a high because this is the highest high price put in before price started reversing lower in this series. So what I want you to do now is to go to your charts and mark out the different highs and different lows you could in on different time frames. This is a 4 hour time frame. You can choose the daily time frame, you can choose the weekly time frame, the 1 hour time frame. Just go to your charts, right? And mark out as many highs and lows you can see, right? And if you go back to the video on market structure, I also want you to carry out an assignment. Try to spot a a bullish market by marking out the lows prices rejecting and also marking out the highs prices breaking in a bullish market. And in a bearish market, I want you to mark out the highs prices rejecting and the lows prices breaking. The highs prices rejecting and the lows prices breaking in a bearish market. Okay, so the next video is going to be on order block. Until then, happy trading.